I saw a statistic a couple months ago. The U.S. has more debt than the next 20 largest country debtors combined. I couldn't tell you who would be buying those bonds. I know I wouldn't buy them. I wouldn't touch that paper.
Hello there, my friends. Chris Marcus here with you for the Miles Franklin channel on Monday, August 27th. And we have a great return guest today, Dave Kranzler of Investment Research Dynamics, who covers the gold and silver market and was kind enough to join us again to help understand what's going on, in my opinion, wild times in the market. So great to have you on again today, Dave. How are you doing? How is the serve doing? And are you ready to dig in?
Thanks for having me back on. It's great to be here.
Cool.
I enjoy chatting with you, Chris.
And that is his tennis serve. So if anyone wants to talk the markets and play tennis, Dave is your guy. But today we will stick to the markets, and something I've been curious to talk to you about for a couple days now, your overview on what's going on in Turkey. Again, we've had currency conditions accelerating in Argentina, Venezuela, now Turkey. So what are you seeing and where do things stand, my friend?
Well, I mean, obviously there's a big scramble around the world to try and get dollars in order to make dollar denominated debt payments. Mm-hmm. And so, a lot of the banks and corporations in these countries are, they when they have to exchange their currency for dollars, they're selling their currency and getting dollars, and that's kind of what's been driving the dollar higher. And that's part of what's been driving these currencies lower. But I mean, the bottom line is all of these countries just took on way more debt. The private sector and the sovereigns took on way more debt than their economy could support. Right. I mean, to be honest with you, the worst offender of that is the United States. And the only reason the United States isn't experiencing the same thing is it's got the reserve currency of the world. So it can print its own money to whatever extent it needs to address its own liabilities. So, I mean, it's right now you're seeing market forces try and correct that situation there. And I don't even think the U.S. would really care, or the U.S. banks would care, except that all of the financial institutions globally, the big ones, are interconnected to what's going on in Turkey, Argentina, and Brazil via derivatives. So, if you've got, say, a Turkish company that issued dollar-denominated debt, and Goldman Sachs says, "Oh, let's sell credit default swaps on this." Right. All of a sudden, you've got these credit default swaps created, and not only is the issuer of the debt short the debt and has to pay it off or buy it back, and the people who invested, the investors in that debt, are now long the debt. Now you've got derivatives that replicate synthetically the long and short positions. And so, it's not like the banks lay off the risk on these. A lot of times they hold them on their balance sheet. So, all these banks globally, the big ones, are exposed. Apparently, and again, I've just read articles about it. I haven't had time to investigate it myself. I've got better things to do. But apparently some of the big Spanish banks are over their skis in terms of their exposure directly to Turkish debt. So, right. I think eventually what we're going to see is we're going to start seeing widespread debt defaults in these countries. And it's sort of similar to what happened in 2008, when all of a sudden, you had European companies had trouble and they started defaulting. And then there was obviously the whole mortgage and housing bubble here and credit bubble here. And everyone thinks that the whole thing was set off by the collapse of Lehman, but really what caused the real firestorm was when AIG defaulted on derivative commitments to Goldman Sachs.
Yeah.
And so I still to this day believe that that was part of the reason that Henry Paulson was put in the Treasury, because they knew it was going to happen eventually, and he was there to implement the bailout of the banks, because otherwise a lot of those U.S. banks, several of them, including Goldman, probably would have been out of business, or at least had to, went through a bankruptcy reorganization. So now we're seeing it in some of these emerging market countries, and it's going to spread. I think at this point, the central banks probably have figured out a way to contain the problem with the derivatives behind the scenes. But you can't tell me that these currencies have crashed like they have, and there hasn't been any collateral damage behind the scenes that we're not seeing that's connected to derivatives. I just wouldn't believe that.
Right. And it's interesting what you mentioned about 2007, 2008. I know on Investment Research Dynamics, you've put a couple articles about that lately, and how it really did begin happening a lot before Lehman, which was September of 2008. In fact, because I remember clearly my first year trading equity options, one of the companies I had, I was back on the American Stock Exchange, and I was trading countrywide.
Oh, yeah.
It was February of 2007. Some blind stroke of luck. Fortunately, I happened to have a bunch of put options in my position. And there was one day in February of 2007 where the stock didn't move so much, but the skew, the price of the puts got jacked. Because I remember after that day, my positions had made a lot of money, and talking with, again, it was new, and talking with some of the guys how to approach that. And then day or two later, the ball did come back in, yet certainly throughout the summer of 2007, I think that was when those Bear Stearns funds started running into trouble. Of course, Bear.
That was actually March and April.
Well, it was March when
February,
they
March,
finally
April.
ended, but even, I remember 2007 hearing a lot about the credit markets, which,
Right,
as you pointed out, similar to now, because, and actually one thing I was hoping maybe you could explain for people who might not grasp this yet, but certainly the effect that the rising interest rates in the US are causing a lot of these countries like Turkey and some of the emerging markets, where it's becoming more expensive. And like you said, with less dollars in the supply, if the Fed is really unwinding, which who knows for sure what they're doing, but if you could just explain a little bit of why this is happening now, why the real estate market's slowing down now, so people can understand what to possibly expect as well going forward.
Well, I mean, in terms of the rising rates, it might cause global investors to shift the way they're invested. They might shift some money out of countries that have lower rates than the U.S. and move it into shorter term U.S. fixed income securities, because the interest rate's a little better. But I think it's really more about the liquidity that the Fed is withdrawing from the system, and it comes out, it basically withdraws from the global system. So it makes the supply of dollars out there that are available for countries and companies with dollar denominated debt. It reduces the supply that's available to go out and grab those dollars so you can make your debt payments. In terms of the housing market itself, I actually think there's an interest rate component to it, but we're only, mortgage rates are only up about 80 to 100 basis points from where they bottomed out.
Right.
And so if you're talking about, 4.5%, 4.75% on a conforming mortgage with good credit score, back in the mid 2000s, people were paying 6, 7, 8% for mortgages and making their payments and still buying homes. And I'm talking about just normal transactions, not the goofy countrywide 125 adjustable rate crap. So I think really what's happened is that the pool of potential home buyers who can actually qualify for a mortgage under the terms that are available now, because the terms now to qualify for a conforming mortgage are much easier than they were in the mid 2000s. I don't think a lot of people realize that. I think essentially the pool of people who can qualify for those mortgages is starting to become exhausted.
Right.
You know, now it takes you only need a 3% down payment, and that doesn't even have to be hard cash out of your pocket. You know, your debt to income ratio can be as high as 50%. And the amount of insurance that you have to pay for putting less than 20% down is a lot lower now than it has been historically. So the government is really kind of, you know, I look at it as the government has kept the house buying gerbil on the wheel by making the terms of qualifying for Fannie Mae or Freddie Mac or FHA or VHA or USDA loan a lot easier. You know, and they've done that the last 3 years. And I think, you know, at some point, they're just, you know, if they're going to try and keep the gerbil going, they're going to have to reduce the down payment requirement to zero. And there's actually some programs out there where you can have a government-sponsored mortgage that has a zero down payment. So I just think from a ability to qualify for financing standpoint, the pool of available buyers is starting to get exhausted. And that, to me, is a bigger issue than, you know, mortgage rates 100 basis points higher now than they were a year ago or a year and a half ago. Now, what would be interesting is if the Fed continues to raise interest rates and mortgage spreads widen out a little bit more, and all of a sudden you're talking about 5.5% to 6% on a mortgage. I think that'll crash the housing market.
Yeah, it's amazing seeing the housing market slow down, and we still haven't hit 3%. And you imagine, God only knows if we had to go to 20% in 1980, what would be a fair market interest rate.
They'll never do that. That'll never happen.
Although, speaking of interest rates, on the list of things I would love to hear Dave Kranzler's opinion on today, because maybe it's still the Wharton conditioning, so I'm missing things. But what's baffling me, and I would imagine many other folks, past couple months, we've seen Russia sell basically the majority of their treasuries. I wrote an article where I cited a report in Zero Hedge that in the latest data, I believe China, Japan, and Germany were net sellers, maybe not as much as Russia, but again, we have the Fed raising interest rates, supposedly winding off its balance sheet. Yet after rates got up to, I think the high I saw was 3.11%. Couple months ago, and today, what are we, around 2.85? So Dave Kranzler, who is buying these bonds? Because I can't seem to figure it out. I have some speculations, although I'd love to hear what you think on that one.
You know, I would tell you that it's the Exchange Stabilization Fund for the most part, but I don't want to introduce, you know, what some people might consider conspiracy theory to the conversation.
Right.
But if you're open to that, I mean, I can't figure out who's buying them either. I guess, you know, in terms of the idea that there could be synthetic shorts in treasuries via derivatives, and maybe guys are, you know, maybe I don't know, maybe the treasuries are being purchased as collateral for I don't know. I couldn't tell you who would be buying those bonds. I know I wouldn't buy them. I wouldn't touch that paper. So
yeah. Well, especially because
I will say now, and this is something that you can see visually if you look at the TIC report every month. There's a category that's just the Cayman Islands, and I guess historically, you know, that was associated with hedge funds. But I think there are people, and I probably would be considered one of them, who believe that, you know, that the Exchange Stabilization Fund has, you know, LLCs set up in the Caymans, and they're buying those bonds. So, you know, the Cayman Island holders, that category of buyer of treasuries has been increasing over the last few reports. So,
right.
Can we prove it? No, but
it hasn't been you out there.
Is there a better explanation for who's buying them? No.
Okay, so you're not the one out there buying the bonds when the yield is 2.85%, and even the Fed's numbers are calculating inflation at 2.9%, which means that to buy treasuries right now, you would be getting a negative, I don't even know if you would call that a real negative rate. Again, that's with
it's negative rate. I mean, real rates are negative, and that's if you use the official inflation number. If you use a real inflation number, rates are really negative.
And that, I might add, would be lending. Again, when it's funny, or not, maybe not funny, but when I see these articles about Argentina or Turkey and they say, wow, their debt is up to 50% of GDP. And then you look at the US numbers where it's already 20 trillion plus. I hear the estimates of Social Security and Medicare from a lot of intelligent folks like Eric Sprott. There's also Lawrence Kolitnikoff, who calculates it at over 200 trillion. So again, you're getting a negative yield to the most indebted borrower in history, which my guess is why, as you've been reporting, there are a lot of countries like China, India, Russia, Turkey, who have been buying a lot of gold. Although I was hoping today maybe you could comment on, I think a lot of people hear regularly that they're buying gold, although maybe if you could put in perspective the amounts, whether, how significant the different countries are, and just help put it in the context of how it fits into the market so people can get a better grasp for that.
Sure. When I first got into doing this sector, 2001, and kind of got up to speed on it, I kind of figured China was buying a lot of gold as a hedge against its dollar reserves, which are treasuries. Because, when you own, back then, I think they had close to 1.4 trillion in treasuries or something like that. Forget where it peaked. And I think they're just a little bit under 1.2 trillion now. I mean, when you own that many treasuries, you're not going to be able to get rid of them. Because if you go to sell them, you're going to push the market towards zero, because everyone else is going to see that and do the same thing. So I always thought it was a natural hedge for them, because if you think about it, at some point eventually, when there's a reset, if those treasuries go to the extent those treasuries are worthless, the value of their gold holdings will probably go up by more than the amount that they lose on their treasuries. So that's kind of what I always thought it was. I think now, and I don't know how long this will take, but I think part of the gold accumulation that you see going on in the Eastern Hemisphere and all these Eastern Hemisphere bloc alliances, economic and political and strategic alliances, I think eventually they're looking to roll out some sort of global currency that includes gold or is backed by gold. So, that's sort of more just kind of a general long-term conversation. In terms of how much gold these countries are buying, we don't really know. I mean, Russia reports its monthly gold holdings at its central bank, and I guess they bought something like 106 tons of gold in the first 6 months of 2018, and they've stepped up the rate at which they're buying gold. But China, we don't know how much gold we're buying, and anyone who claims they know is lying, or they're just clueless. Because the only way that we can track gold, we know that China produces, 400 tons a year, 450 tons of gold a year, something like that. They're the world's largest miner of gold. But the only numbers that we can track in terms of what gets imported by China is the gold that goes from Hong Kong into China, and then it has to go into the Shanghai Gold Exchange. Some people probably aren't aware of this, but every ounce of gold that is distributed in China, whether it's to retail investors or whatnot, has to go through the Shanghai Gold Exchange, except for the gold that the PBOC, People's Bank of China, buys. They don't have to buy their gold off of the Shanghai Gold Exchange. That's a lot of people aren't aware of that. Mm-hmm. However, China, and I think it was 2012, I have the article saved somewhere there because it was an article from the South China Daily.
Okay.
When China opened up the ports of Beijing and Shanghai for gold importation, But I remember the article specifically said that they were not going to report the amount of gold that goes into China through those ports. And they purposely did that because they don't want the world to know exactly how much gold they're accumulating. So the truth is, I think if you take what China reports at face value, I haven't even seen, I don't even really pay attention to it because it's a waste of brain cells. But I think the last number I saw was maybe they have like 1,200 tons or something, or 15. I forget what the number was. It was a ridiculous number, and everyone knows it. Everyone who's studied this sector knows it. Probably the guy who I think's done the best work on it, and probably has the most accurate estimation. And that, again, it could be off by quite a bit. And if anything, he's probably low. Is Alistair McLeod. He's I think he said it's somewhere between what they own, what the PBOC or the Chinese government and the central bank own in total is somewhere between 25,000 and 35,000 tons. And again, I don't spend a lot of time looking at those numbers because it's not something we can ever verify or prove.
Right.
But we do know that China's been accumulating gold for a lot longer than any of us thought. I mean, back in 2001, I wasn't aware at that time that they were a massive accumulator of gold, but apparently they've been doing it since the 80s, according to Alistair. So,
right.
And again, to me, it's just kind of, he who controls the gold makes the rules. And I think that's where China's headed with this.
So despite Ben Bernanke saying he doesn't understand gold and doesn't know anybody else who does either, or Warren Buffett or Mark Cuban saying it's a useless relic, go throw it out in the pool somewhere. Again, it seems to me that there is a lot of money in the globe, whether it's happening on a retail level or in the mainstream media of America. It seems, because you mentioned in one of your recent interviews how you thought your subscriber count, because you're writing about gold all the time, would be going down in this market, yet it was actually increasing, indicating that there is interest in this. And again, maybe we're looking at one data point, but also it's not just one data point, your subscribers, but also, some big players in the market. I mean, China's not, a little $10 million hedge fund. So it seems like there's a reason someone's buying it and buying a lot of it.
Well, gold is money. I mean, I love that exchange between Ron Paul and Ben Bernanke in Congress, where Ron Paul asked Bernanke, is gold money? And Bernanke sits there for a second and just goes, no. He has the dumbest look on his face.
Tradition.
No. And to this day, I'm not sure if he really believes that it's not money or if he was just being a politician there. So, I mean, gold's the oldest form of money, and we know that. And it's stood the test of time. I mean, the dollar's been around. The U.S. dollar's been around, I don't know, for what, a couple hundred years, and it's been the reserve currency since '71. I mean, that's not the test of time. Mm-hmm. And look what this country has done to itself since it had control of the world's currency. As you point out, you got 21 trillion of just Treasury debt. That doesn't include the Fannie Mae, Freddie Mac, the government mortgage debt, which now the government guarantees.
Right.
You're talking
so
about
it's essentially added to the debt.
Another 8 trillion of that. That's 29 trillion. And the GDP, and we know that the GDP is a hokey number. The GDP is what, 18 trillion?
Right.
I mean, I saw a statistic a couple months ago. The U.S. has more debt than the next 20 largest country debtors combined.
It's amazing where you look at the way people respond and they still see the U.S. as the flight to safety, the safe haven asset, which I guess all I can say is that if you thought about what would I do if I wanted to set the conditions in place that would force a massive break in the market similar to what we had with the housing market, it's like all this stuff that you're doing right now virtually you know, if you take a hammer and keep smashing your knee harder and harder, you know, you're going to get a predictable result. Again, I know this is a challenging time for people who've been owning gold and silver. Certainly on the one hand, you know, again, if you're still working and earning income, I'd like to point out that if you do want to add to your holdings, the low price goes in your favor. Of course, now there's the other group, and certainly when I left Wall Street and was living off my savings for a while, I can understand what it's like where you wish the thing would go up now. So in closing, you know, for the folks who are out there saying, all right, yeah, it seems like it's manipulated, we get all that, you know, what would you say to them? I'm curious, do you think this could go on another 5 years, another 10 years? I've thought since I left Wall Street in 2012, it's interesting, I heard Craig Hemke say something to a similar effect of back then, I was stunned that it was still going on. And you wrote earlier this week about how it's not that we didn't anticipate what was happening, but just the degree to which things are manipulated. So I'll end my long-winded question here. Just, do you think it could go on another 5 to 10 years? And what would you say to people who are kind of sitting there a little frustrated at this point?
I mean, you know, like Craig, I mean, I was writing about what happened you know, like there's some guys out there that claim they're the ones who called 2008. Well, a lot of people saw it coming, and I was one of them. And I thought that what happened in 2008 was going to be where everything would get reset, but none of us foresaw the Fed opening up the printing press to the extent that it did. I mean, it printed what, close to $4.5 trillion, and that's small compared to the amount of credit that it made available.
Right.
So you know, I mean, no one thought that we would see something like that. It's kind of like you look at, well, didn't we learn our lesson from what happened in Weimar Germany? So, you know, can this go on for another 3, 5, 7, 10 years? I have no idea. That's one thing that I've learned over the last 18 years of doing this is, you know, it's useless to make predictions because every step of the way you underestimate what kind of rabbit these guys can pull out of the hat. And I mean, let's face it, part of what they're doing is it's a massive scheme to confiscate wealth from everyone else. I mean, you look at the wealth distribution numbers over the last 10 years, most of the wealth that has been created, and it's all inflationary wealth, it's not real wealth, has gone to the upper 1%. And I think if you could dissect that upper 1%, I think you'd see most of it's gone to the upper 0.5%. So, you know, we're going to see some sort of skeleton's going to pop out of the closet. And I don't know what or when, but it's going to cause another 2008 type accident. And that accident is going to be a lot worse because the actions that they took to keep the gerbil on the wheel in 2008 has actually, you know, you say they injected heroin and meth into that gerbil to keep him going and not feel pain and keep his body hyped up. Well, you know, at some point, big doses of heroin and meth aren't going to work on, and the gerbil's going to die. And I think we could be at that point, but you know, I think if they were going to do something to keep the gerbil going again, they'd probably have to print 3 times what they printed.
You would think so.
And I think if that happened, I think that's where you'd see the dollar collapse. So,
yep.
You know, I think we almost saw a dollar collapse back then. The dollar got down to 71, and we were all looking at that, and it was like, or 70 even, I think, intraday one day. If the dollar goes below 70, it's going to go into the 50s very quickly. Yep. And, you know, that's still probably the magic level to watch is that 70, 71 level. So I know it may seem like we're never going back to that level right now where the dollar is now, but, you know, when it starts to happen, I think it could happen a lot more quickly than people realize. I can't tell you what the timing is on that.
Yeah, well, I appreciate you saying that. And again, I know everybody's curious when I do my best to do a good job of saying, geez, these are all the factors that would indicate something at some point must happen if the world ever reverts to logic of supply and demand. You know, and certainly I think all of us are looking as closely as we can to see when the moment happens. Of course, given that it hasn't happened yet, I think it's good that we're not reporting a specific date. And again, I appreciate you saying this, because for me, I was sitting on the trading floor. Again, I mentioned trading countrywide, and that really led me down that path. So I was caught blindsided by that one, but then started reading, you know, I was first reading Peter Schiff and, you know, other people like you that actually did see it in advance, warned about it in advance. So again, I know it's a tricky time for people, but you know, for everyone who watched The Big Short and says, wow, I wish I could see something like that. Here it is setting up, and the chance to buy metals in many cases below some of the, what it costs many of these companies to get it out of the ground, when you have stock market. Actually, I'm sure you'll know the answer to this one, but how much do you think the NASDAQ is up since its 2009 lows?
What if I don't know the answer to that? I don't know. What's it up, like 400%?
Sevenfold. I was looking at the chart the other day, and at least if my math is anywhere near accurate, I was either looking at the ETF, but it was up about sevenfold since the March of 2009, while gold up maybe 50%, silver kind of in the same area. And certainly, geez, if you have a similar dynamic to what happened last time and that money starts flowing out of there, again, whether we're at that point yet or not, but I know there's a style of investing that's developed in today's markets where people wait for the price to go up before buying. But certainly if you're aiming for the buy low and sell high strategy, again, I appreciate hearing this come from someone who was publicly speaking about what happened before things collapsed the last time. And I'd actually also like to point out, I know you covered Tesla in this situation a lot, and how there a couple of weeks ago, there was the rumor that Tesla might be part of a buyout. And you were very vocal and adamant saying that's ridiculous for a variety of reasons that you have on your website, and I recommend people check out. And of course, sure enough, I got my Wall Street Journal alert a couple of days ago saying there will be no buyout. So again, you know, don't take my opinion for it, but for the audience members, hearing someone who is saying these things before they happen and also confirming the gold and silver, which again, I know it's a challenging time for people, but I really appreciate you visiting us again and sharing this perspective, because I think this is what, you know, just like in the movie The Big Short, they had to go through that period of a lot of stress and pressure, but I think this is part of what leads to winning in these situations. It's trained me in being patient in ways I never would have guessed before. So I thank you for coming on with that, and any closing thoughts, and tell people how they can find you.
Sure. Well, thanks for having me on. You know, in terms of the NASDAQ and up sevenfold, I mean, most of that is just a handful of a few stocks. I mean, in 2008, Amazon went from 100 down to 35. So it's gone from 35 to, I don't know, it's like over 1900 now. So it's stocks like Amazon and Apple and Microsoft and Nvidia that have been Netflix that have driven the NASDAQ. It's not all the stocks. And if you look at the price of gold, and from where it started in late 2000, early 2001, it was 250 an ounce, and it went all the way up to 1900. But if you measure gold versus the S&P or the Dow from 2001 to now, gold has still outperformed the S&P and the Dow, not the NASDAQ. It had been outperforming the NASDAQ until the NASDAQ really went parabolic. But I mean, when you invest in gold, you're in it for the long game. I mean, we're fighting, you know, central bank manipulation. It's a very political metal. It's especially the Western central banks. It's in their interest not to have the price of gold go higher. I think they're kind of at the point where they're not going to be able to push it any lower from here. Mm-hmm. You know, and if you're getting kind of bummed out about, you know, just watching your gold sit there while, you know, Amazon goes up $20 every day. I mean, think about, would you buy Amazon here? would you rather buy an ounce of gold here or you know, a share of Amazon stock? I know what my answer would be. I mean, what's your alternative? I mean, you're not going to buy dollar denominated investments. You're not going to buy treasuries. You're probably not going to chase the stock market. What are you going to do with your money? To me, there's really no alternative, you know, and you just got to sit tight and be right and not watch it day to day. Yep.
And there you have it from Dave Kranzler, Investment Research Dynamics. Thank you again, my friend, for joining us today. It's always a pleasure to talk to you. Dave does have the Mining Stock Journal and the Short Sellers Journal, which I think I actually got the new one this morning. So I will be looking forward to going through that. I've actually been thinking about establishing a short real estate position myself. And it's great having these reports, having you on here. So thanks again, my friend. We'll look forward to having you back soon and talk to you soon, my friend.
Thank you. And you'll look forward to my Tesla section in the latest Short Sellers Journal.
I'm already excited. Talk to you soon, Dave.
Speak to you soon.